Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, November 15th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not investment advice. I am not a registered financial advisor. I cannot give you personal financial advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, going through the chart deck. So interesting chart from Zero Hedge, the gap between Wall Street and Main Street. It's interesting that I think we've reached peak new administration. A lot of people are upset. It seems to be last week was a kind of the Laura Ingraham interview with Donald Trump. If you haven't watched it, it was kind of a Marie Antoinette, let them eat cake type of speech or type of interview. The president really out of touch with what's going on. I'm not going to get too far into it. I think, I'm kind of cynical about politics to begin with. A lot of people were putting a lot of hope into this administration. We talked about the Reagan-Volcker potential at the start, the Doge, all those things. That's all been canned for whatever reason. We're back to, unfortunately, meet the new boss, same as the old boss. And so you see consumer sentiment crashing, yet the S&P making new highs. I think that's going to change soon, though, the S&P 500. Maybe not, we'll see. But I think there's a lot of risk out there, as I've been saying for a while. But in the last few weeks, it's really kind of really taken shape. We'll get into that in some subsequent slides. One good thing is rents are coming down. I suspect a lot of this has to do with the fact that of the deportations that are happening. Um, that is one success that the administration can point at. But I can already see that, as I predicted, angst and opinion is rising against the administration because you're sending out these people to just grab people. Yes, I fully agree with doing what they're doing, but I'm not the majority. The majority of people, I told you, are not going to like those levels of violence that are necessary to deport millions of people. Now, we have had a lot of self-deportations. A lot of people just threw in the towel and said, I'm out of here, went back. We don't know the exact numbers. We do know that you can go to the Homeland Security website and see the level of deportations of people they've grabbed. A lot of these people are people that had deportation orders or removal orders, and they just ignored them and stayed. And so they're grabbing these people up and sending them back. But I think a lot of these people are renters. And so if you take away demand, if you have a relatively fixed amount of rental units, it doesn't grow that much every year. Maybe, I don't know exact numbers, but the supply doesn't grow massively every year. But if you have a shock and take away a lot of the demand, then you're going to see prices come down. And you will see that basically, as the administration was inaugurated, it just basically, when they started ramping it up, it just started coming down. Now, this also could be, uh, you know, with respect to the economy weakening and things like that. But I think this has a lot to do with, I think a lot of things, the data is kind of reflecting this. So as supply stays relatively small or fixed or grows very slowly, and the demand, you get a demand shock by removing a bunch of renters, you'll see the price come down. So that could be positive on the inflation rate. The thing that's not positive is the cost of groceries continues moving higher. This, you see how it basically, you see the long-term inflation basically from the long-term money printing that goes on going back to 2017. This line goes back to 2017. But you see during the pandemic how everything took off because all of the trillions of dollars that were given away and printed. And of course, again, you can't immediately increase the supply of groceries relative to the um, impact of increasing the amount of money out there. This is simple 101 economics that most people don't get. what I find fascinating, and I've mentioned time after time, I hear all of these populist arguments. We have had a recent elections, off-year elections, the blue wave, if you will, and you see the left left populism now coming to the forefront, talking about affordability. That's the new buzzword that everybody's using in the political class, affordability. But what are the solutions? All these rerun solutions that don't work. Government run grocery stores. If you want to even go further to the left into socialist and Marxist thought, price controls, this stuff doesn't work, okay? No one talks about the real problem. Excessive government spending enabled by money printing from the Federal Reserve. No one even discusses that, mostly because most people don't understand how it works, okay? That's not even discussed. Well, wait a minute. Are you telling me, John, that if we just give we have 1 out of 8 people in this country on SNAP, evidently, which we found out recently. Okay. So if you have, more than 10% of the population getting free food, you increase the money supply. I mean, you see what I'm saying? Now, hopefully, they look like they're starting to clean things up. They did a survey, USDA did, ag secretary. Found this interesting. The whole government is just riddled. Federal government and these programs are riddled with all kinds of fraud, waste, and abuse. But they found that they did a survey, and I think the majority of the red states responded dead people collecting benefits, people multiple accounts, all this kind of fraud. Not the whole thing, of course, but you gotta root that stuff out. Okay, people get over it. I'm down here in the Rio Grande Valley. Okay, South Texas. Medicare food stamp fraud is rampant. It's very easy to find people that will let you hold their EBT card. Say there's 500 on it, you give them 250 and you can get 500 in groceries. You give them 250 cash, they'll let you take more than that out in EBT or food stamps. Nobody at the store checks. They don't check your name. They just stand there and you swipe it. I haven't done that, but I know many people that have done it that do it. It's rampant. Medicare fraud down here is rampant. All kinds of fraud, waste and abuse in government programs. It's rampant. And I'm sure this isn't the only place. It's just how it is. There's so much money flowing out of there. That doesn't help things on pricing. And then all of that spending is enabled because the government doesn't really have the money. We're running these huge deficits. It's enabled by Federal Reserve ultimately buying treasuries and mortgage-backed securities. That's what led to the big, housing unaffordability. But no one even discusses it. It's not even discussed. We're just going to go back to the same. We're going to have government-run grocery stores. We're going to have price controls. The grocery stores make too much money. All this nonsense that has nothing to do with the ultimate root of the problem. So foreclosures are moving higher now. Obviously, from a very low level, you see that this is the last housing bust, what happened, the amount of foreclosures by quarter. You see that during the pandemic, they basically put moratoriums on foreclosures, and now those have been lifted, and we're slowly growing back. But we're not even back to pre uh, GFC levels, but we're growing. We got a problem here also. Okay, and this is going to be a problem as I'm getting ready to show. I think because uh, the housing, we're just in the middle. If you listen to, I think that gal's name's Melody Wright. I like listening to her. She's on YouTube. She's the gal that has driven down to these different cities over the last year. She goes around. She used to be in the mortgage business, real estate business in the GFC, if you know her background. And she's saying that, hey, we've created another potential real estate bubble that's going to be as gruesome or worse than the 2008 bubble. He goes to these neighborhoods where they're building homes and sees, all the incentives they're doing, the overbuilding, all this stuff that's going on. And so we're not even, we're coming out of this moratoriums and all this stuff, and now the foreclosures are starting to go up. Also, I think a lot of it is not a lot of it, but a good portion of it. We don't know yet for sure, but we're getting an inkling that a lot of it is people that didn't have didn't ha- illegal aliens and H-1B type people that had mortgages that are being foreclosed on. I mean, if you get deported out of the country and you had a mortgage, you're not paying it, it's going to be a foreclosure. A lot of these people were getting FHA loans. They weren't just going to the bank, they were getting government-backed loans. So here we go again. It's just unbelievable. So, I think we could be on the verge of a really, really bad economic performance going forward. So it's something to put on your radar screen. This is from a very low level, but it's increasing. And if you see the prices around the country, I think a lot of prices are down double digits in a lot of metro areas. So here's a 30 days delinquent by mortgage type, FHA, VA, other GSE. They kind of bottomed in 2021 after the pandemic and moratoriums were lifted, and here's what we have. Okay. So just another, it's not the end all be all. There's 60 days plus 90 days. I don't have all these charts. I'm just showing you what I collect during my reading during the week. But this is definitely, increasing, let's say. I mean, we're getting up to levels on FHA that were consistent with the GFC. This is concerning. So this is FHA loan locks. This is when you go apply for a loan, then they lock in the rate for you, FHA backed loan to immigrants without permanent residency, including H-1B visa holders. And you see how look at all of the loans that were given to all these people as they came into the country. This was the during the Biden administration, flooding the country with immigrants, and they were all getting FHA loans. It's unbelievable, guys. It's just unbelievable. And people just sit there and just, don't get it, I guess. And so now, if people are being, like I said, if you're being deported or of course, we have the Trump administration and the Marie Antoinette Laura Ingraham let them eat cake interview where he said he's going to let in 600,000 Chinese uh, people to go to college. And he's going to increase the amount of H-1B visas. So maybe this will reverse it. I don't know. But this is not cool. And then you see where they ban finally, there's no reason that if you're an H-1B visa holder or an immigrant, an illegal alien, somebody without a permanent residency here, okay, that you should be getting government-backed loans. Okay. So they finally knocked it off in May and it collapsed. Okay. It's collapsed now. So uh it makes you wonder. So is your government, whether it's Republican or Democrat, for you? These people hate you. They don't care about you. Okay. People are being locked out, creating families, the cost of living soaring for American people. And this is what they did. Okay. So anyway, this is not going to be good, I think, for housing prices because when the foreclosures happen, then, the banks are stuck with this stuff. They're not in the real estate business. This is why I've taken a speculative position in Altisource portfolio, which did very well during the last housing bust. Now they got creamed. They almost went bankrupt, I think, during the moratoriums during the pandemic and stuff like that. But as we see foreclosures starting to climb, this is right back in their wheelhouse because what do? One of their primary businesses is that they offered banks is, okay, Mr. Banker, you have houses, you have a foreclosure portfolio, houses, this portfolio full of foreclosures, and what the bank isn't in the real estate business, doesn't manage real estate, doesn't it's not a property manager, and so Altisource does this. They manage the properties, make sure they get taken care of. They did very well during the last housing bust. And this is why I've taken a speculative position. I don't know if we're going to have a housing bust. The argument that many of the housing bears are making are very persuasive in my view. So I think it's worth a taste. It's worth a speculative, small speculative position and watch it. and see what happens. Okay. And because last time they did very well. So that's one way to take advantage if, in fact, this is going to become a problem. And I think it is going to become a problem as we get into 2026 and continue moving through. Uh, I think housing prices are going to come down massively. One of the things that wasn't considered by these mass deportations is what effect would it have on, it could have good effects by lowering rents, but it also could cause, a wave of foreclosures. And what does that do to existing homeowners? So there's always cause and effect to everything, and there's always unknowns. This is part of the reason why I think you really need to, why I encourage people to really do second and third level thinking. Okay, just don't look at the obvious effects of a policy, the obvious effects of something, but look at, okay, what else could it affect? And that's where opportunities are created. So I'm not telling you to go out and buy Altisource portfolio. I'm not telling you to, do that. I'm not saying it's a good investment. It's a speculation. That's just something that I mentioned. It probably won't make it into the portfolio, AIA portfolio, but occasionally I drop these breadcrumbs to show you the kind of thinking that we use in the Actionable Intelligence Alert newsletter. Okay, so this is from Bloomberg. This is another chart that got dropped. We've talked about this many times. Mag 7 is the stock market. Well, they call this the Bloomberg. This is from Bloomberg, calls the Bloomberg Magnificent 7 Index. You see it from 2019 to currently 2025. It's blown up. Yes, everybody's making money. Happy days are here again. But here's the other 493 stocks. Basically, we've talked about this before. Mag 7, the tech stocks, the AI stocks have basically are the stock market. It's where all the returns been. And the return in the rest of the market has basically been negligible. This is very dangerous because I think we're coming to a head with the whole AI boom, the whole tech boom. So we are coming together like kind of like what I'm seeing here, kind of what not only are we going to possibly you are on the verge possibly of let's play this out. And I'm not saying it's going to happen with certainty, but it's the potential is not zero to have two hurricanes merge into a superstorm. What do I mean? Mag 7 is it on its last legs? We're going to talk about how AI is probably a big bust getting ready to happen because there's no way to make money in it currently. Kind of shades of reminiscing of the tech bubble when the internet first took off. Now, the internet has inculcated itself into everyone's lives, and there's plenty of people making money with it now. But 25 years ago, nobody knew how to make money on it, and we had a big bust. Something similar, I think, is going to happen with AI. Combine that with stress in the real estate market, okay, that's starting to grow. Do we have a superstorm of a housing bust and a tech bust at the same time? Wow, that could be something. So this is it's the potential I think is not zero for that to happen. So here's a chart, AI related revenues and capital expenditures for four leading tech companies in 2025. I've been talking about the fact that these big tech companies have changed their business model. They've become very capital intensive because of this AI race, okay? This kind of like an arms race, if you will. I remember Zuckerberg saying you're going to spend billions and billions of dollars, and I've seen some other people interview like Sam Altman and these other people. Well, where is the profits going to come from? And they're dismissive of it because they don't know. But Zuckerberg said, I have to spend the money because if this thing takes off and Meta's not part of it, then we're out of business. And so we have all these people in an arms race, if you will, in italics, about AI spending billions and billions, tens of hundreds of billions of dollars, okay, which was not their business model. Their business model is very capital light, if you remember, software, you know, yeah, you have a little bit of server farms to run your, Facebook page or whatever, your alphabet search. But now this AI thing is like way more capital spending, and there's no profits coming in. There's no revenue. This just shows you. So um, this is just in 2025. This is the AI products revenue, not even profits, revenue. Okay. There is no profits yet. And here's the AI capex. Microsoft, 13 billion in revenue, 80 billion in capex. Amazon, 5 billion in revenue, 105 billion in capex this year. Alphabet, 7.7 billion in revenue, 75 billion in capex. Meta, 3 billion in revenue, 20, it's basically 72 billion, 25 times more spending. Okay. And the argument, so in total, just these top four, that doesn't include Oracle and some of the other ones, it's 28.7 billion in revenue, no profits, and 332 billion in capital spending. Okay. With more to come, evidently, next year. And you have this open AI thing that's not even public. The guy basically just waves his hand and says, I don't know, he doesn't even want to talk about the revenue and profits because there aren't going to be any. No one can see where there is any yet. Do I think that does means AI is going to go away? No, it's not going to go away. People are finding more and more applications for it. Okay. That's why if you're in a white collar job, you're going to get wiped out. Robotics and AI is on the march, whether you like it or not. But right now, with an historically overvalued stock market and no profits, and these are the main four out of the top seven stocks, now they have to build power plants. Now they have to do all this other stuff. They're getting pushback from regulators, which we're going to show. Basically, bring your own beer type thing. I'm going to get into that in a subsequent slide. They got a lot of problems. They're going to cost a lot of money, and there ain't a lot of revenue, and there ain't no profits. Now, that's going to be able to continue until the dream fades. Then it's going to be a problem. And any economic growth we are having in the U.S. is basically being driven by this nonsense, the capital spending. What if it stops? What if it gets cut in half? What if it gets cut by 90%? You got a big problem. Do you think the stock market's going to stay at these elevated levels once people realize, hey, what's the leash? How many quarters of leash do these companies have before they can't BS people anymore? So okay, this shows for these companies, basically the average EPS, earnings per share growth, last 4 quarters for these companies. Estimated average earnings per share growth next 4 quarters. Um, yeah, that's a problem. Now, these are estimated EPS by analysts. Maybe the analysts are all wrong. Maybe the earnings will be there, the growth will be there. But without this type of numbers coming in, if you have this, and then people are going to start looking at the capital spending and going to say, these companies are no longer growth companies. Why am I paying 30, 40, whatever times earnings for these things? I'm going to pay 30 times earnings, 40 times earnings, 50 times earnings for a stock that has EPS growth of 2%. You might pay 8 or 10%. They start becoming like low growth companies. This is a problem. And if there's no revenue growth, no earnings growth, cash flows, that's why they're going in this tremendous debt to build out this is really it is a real bubble. So this could actually be, you know, like I said, part three of this whole superstorm of the US economy that's just going to blow sky high possibly. Now, I'm not panicking. I'm not trying to be a chicken little. I'm trying to identify this is a big risk. I've been talking about this for a couple of years in this AI thing, that this business model, I don't, a lot of smart people, even Murray Stahl was talking about this even before that, didn't see how this business model worked. There's no revenue, there's no profits. They have to have those, especially if they're incurring billions and billions of dollars in debt. They asked Sam Altman, where are you going to get the hundreds of billions of dollars for OpenAI? He doesn't answer, just hand waves it away. Okay, take the company public for $1 trillion. I mean, P.T. Barnum said there's a sucker born every minute. This could have tremendous reverberations through the entire economy. If you were around for the GFC, if you were around for the tech bubble, you saw what can happen. And if we do get a market drawdown in S&P, yes, all of our stocks will go down too. Okay. But in that situation, what is the government and Federal Reserve going to do? Man, they are going to print so much money. If you want to know how gold gets to 10,000, this is what I said. For gold really to break out and become mainstream and for it really to have its blow off top bubble, we need the S&P, we need the tech bubble to blow up because all of the interest is still here. It's sucking the oxygen out of the room, sucking the liquidity out of the room. So we'll see what happens going forward, but you need to be aware of this. If you're invested in the S&P 500, and because if you listen to Mike Green, because of passive investing, a lot of people in their pension funds and their 401ks and their target maturity funds for 2050, 2060, they're invested in this crap because they're in S&P funds and the as these market caps of these companies have grown, their percentage of the total of the S&P goes up. So every dollar that goes in from your 401k is perpetuating the stocks going up. And do they warrant it if their growth rates are here? At some point, people wake up. The dream is over. Now, again, maybe the analysts are wrong. This is not good. This is not good. So Michael Burry's had enough. This is the Big Short investor. Probably time to watch that again. Investor Michael Burry accuses AI hyperscalers of artificially boosting earnings. He had a Twitter post or an X post about this and was also on CNBC. I'll put an article to the link for the CNBC article and the Twitter post in the show notes below. Here's a few snippets. Michael Burry, the investor made famous by The Big Short, who recently roiled the market with a tech short bet, is accusing some of America's largest technology companies of using aggressive accounting to pad their profits from the artificial intelligence boom. In a post Monday on X, the Scion Asset Management founder alleged that hyperscalers, the major cloud and AI infrastructure providers, are understating depreciation expenses by estimating that chips will have a longer life cycle than is realistic. Quote, understanding depreciation by extending useful life of assets artificially boosts earnings, one of the more common frauds of the modern era, Burry wrote. Massively ramping capex through the purchase of NVIDIA chips servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done. Now, he's not the only one that's talked about this. A lot of people have. And so you have a lot of basically non-cash earnings if you extend the depreciation. Uh, so I would read the article. I would read his Twitter. Now he's been wrong, of course. They haven't dropped yet. I don't say you should go out and short these things, but I definitely think that we're coming to a reckoning. And nobody in the SEC or anybody's going to do anything about this because, it's nobody wants to go and rattle the cage of the golden goose. Now, if in fact we do have a big dislocation in the market and if it ripples into the economy, which it will, then everybody will be like, gee, no one saw this coming. After every bubble, that's what people say. But as we've said, the data, the signs were everywhere. People just choose to ignore them because they're getting rich. So here's another problem that they have. PGM, which is one of the ISOs, which is up in the Northeast, Pennsylvania. PGM to data center operators bring your own generation. So they're PGM, who operates the grid up in the Northeast part of the country, part of the Northeast, Pennsylvania, parts of Indiana, all these places, New Jersey. They're basically going to require new large data centers to bring their own matching generation as a condition to interconnect to the grid. So you can't just build. So what the problem is these people are building all these data centers. You know, we've talked about how they are energy hogs, and they're connecting them to the grid, and it's causing prices to go up because the supply of electricity is not keeping up with the demand. So they're saying we're not going to allow you to connect these data centers anymore unless you have your own generation. PGM capacity shortage driven almost entirely by data center load additions, actual plus forecast. Without bring your own generation requirement, it creates a massive wealth transfer to other customers via capacity costs, transmission upgrades, and RMR obligations. Alternative approaches, status quo, demand response, co-location, all degrade reliability and shift costs to existing customers. Data centers forecast to add 30,000 megawatts to the system cannot serve this reliably without new generation. So the PGM or ERCOT or MISO, these are the interconnect facilities or the people that are responsible for keeping your electricity grid 99.99% reliable. So you can't just put a new solar farm or a new gas turbine or a new nuclear plant and build it and connect it. You have to go through a process. And so what you do is you submit, there's all this paperwork you got to go through well in advance of constructing your power plant. Or even if you're going to have a big load like electric arc furnace or something in a steel making facility, and you have to say, okay, this is the facility, this is what we're going to generate, this is how we're going to generate it, this is how we're going to have all the protection devices, and then this is where we're going to put it, and then they go and look at it and say how they're going to integrate it into the system, okay, and then they say yay or nay, or you have to make certain changes or upgrades possibly to the infrastructure to accommodate the new load or the new supply or new generation supply. That's how it works. And so it's all, being controlled so you don't just have willy-nilly and then you have chaos on the grid. So what's this do? Now you have to get into the power plant business, as I've said before, if you're Meta or these other people. Is it a high margin business? Well, I was in that business for a long time. No, it's not a high margin business. It's usually where regulated utilities play and you have your cost plus whatever the Public Utility Commission says. So plant costs 250 million, plus 10%, whatever profit margin. You have guaranteed profits, but you have responsibilities under that too to maintain things a certain way, reliability, things like that. That's not 60% margins or whatever these companies had before. Now they have to get involved in all of this. Now you have to get the fuel. Now you see what I'm saying? It's creating you're taking these low margin businesses and all these problems and attaching it to your capital light business. And this was always going to become a political issue because we've talked about it several times how prices, especially in PGM, have soared for electricity and forecasted because of all this new demand. So that's what they're saying. You have to bring your own generation. This was going to become a populist issue. I pretty much said that a while ago. So this will slow things down. This is why you have gas turbine sales soaring. Okay. This is a little bit busy of a chart. This is the uh, gas turbine unit orders year over year, unit change, GE, Mitsubishi Heavy, Siemens, and other. You see how it just is basically blasting up higher recently. Here's the capacity orders in megawatts. It's kind of been a trend. So what happens to all these orders if this thing blows up? This is why another reason why these companies were hesitant to just go out, and this is why they have these huge backlogs and they're hesitant to just go out and build all this new capacity to build these things because they did that at the turn of the century of the aughts when there was a big deregulation push and all of these they called independent power producers built all these gas turbine plants to take advantage of the markets, and then a lot of them were left stranded. I don't know if you remember that, but I remember it because I was in the industry. There was a lot of plants built, and some of them just sat there and didn't even operate. It was crazy. So, commodity market progression from Tavi Costa, first gold, then copper, now watch energy. So you see how gold has soared, copper has taken off, and you see now energy stocks. If you look at a lot of the energy stocks or oil stocks in particular that I follow, that I have in the portfolio, they've actually begun to rally over the last several weeks, last month. The oil price hasn't really moved. What's interesting to me is all of the negative news around the oil market, AIA issues, some of the bad news we got out of the shale in the U.S. The shale was not rolling over; it was actually increasing production. OPEC, but oil still hasn't broke down. Is the U.S. in recession? Very possibly. Europe's in having economic issues. The issues with, you could say, well, the geopolitical premium is holding the oil price up. Very possible. But I find it interesting that with all the negative news, oil hasn't broken down to, into the 50s or 40s. Now, WTI has gotten under 60. Brent seems to be holding above 60. That is that's kind of an indication to me that, it's absorbing all of this bad news. That's actually bullish. And then the stocks are actually starting to get some legs under them. Is capital starting to come in? Is smart money starting to say, okay, yeah, we can see what's going to happen. You know, demand growth is relentless. I've talked about this before. Um, there was a good discussion on money and mines. I'll have it on the free weekly email that'll come out Monday or Tuesday, the AIA free email with Paulo Marco uh, talking about this exact thing around commodities. The commodity bull cycle, which my view has been that it's not going to be primarily driven by demand like the previous one when China came into the WTO and all of that, and expanded in the aughts, when it was basically a black hole sucking in all the commodities. But this is going to be more of a supply driven. For example, in copper, I mean, the copper supply is really struggling. You had the big mine issue at Grasberg, which is one of the biggest mines. You have the ongoing issues in Chile at Escondida, supply issues. The Teck having problem bringing its QB2 mines online, copper mine. The issues with the Ivanhoe mine in Congo, um, and just the overall lack of new mines, copper mines. That's just an example. Yet copper demand's increasing. We can look at previous S curves for emerging markets and see that when GDP gets to a certain level, copper, oil, all these commodities inflect upwards. Okay. And we're getting to that point with a lot of these emerging markets. Yet supply has been starved for capital in many of these things. Now, if we do have which is unknown, we can't know the future. If we do have a dislocation in the markets here in the US, a lot of these stocks are going to go down. In a stock market, bear market, most stocks go down, but that will be the buying opportunity of a lifetime because I can tell you that if there's an economic dislocation, if there's a stock market decline of 20, 30, 40, 50%, that the Federal Reserve will be there liquefying the system like you won't believe. And you already have most of the world in a rate cutting cycle, which it has been in for 2 years. As I put up last week, this idea that the world's in a recession is not true. Look at the data. Okay. The IMF is even increasing its global GDP for next year predictions. Okay. So this global recession that we're supposedly in, the trade war with China is over. We lost. We never had, you know, we went out there. We were like those armies that you used to read about where the guys would come out of the trenches and they didn't even have enough rifles for everybody. People were carrying pieces of wood, shaped like rifles. That's kind of what, the United States got exposed. So we had to back off like on the rare earths and some other things. Okay. So here we go. Supply is down, and I think the world doesn't revolve around the United States anymore for demand. Yes, the news cycle, the perception, the short term dislocations that can happen in markets, but what is the long term? And again, I don't know. Maybe this AI thing, they'll pull a rabbit out of a hat. Maybe the decline will be over time. I don't know. Maybe we won't have a crash. You can't know the future perfectly. And so I see what I see, and I think that once once this AI thing gets realized that it's not going to be the Shangri-La that everybody's projecting, then I think liquidity is going to move in some of these other sectors. We've talked about it over and over. It already is, but I think you get a wave of liquidity once people, once that stops working, AI bubble stops working, then investors and money starts looking for other sectors that are working. And these sectors are working for us. These sectors, emerging markets are working for us. Okay. Again, you could have a dislocation in the US. It'll grab the headlines. People will get scared. Sentiment will shift. People will sell, throw the baby out with the bathwater. That could be a tremendous opportunity if it does happen, but it won't be the end of the world because we know what the Fed will do. We know what the government will do. They will spend money and they will print money. Print or die. That's good. That's bad for the dollar, but good for commodities and emerging markets. And if it doesn't happen, the dislocation in the markets, then we still win. Heads I win a lot. Tails I win, but not as much. I still win. That's kind of the situation we're in. So I'm holding to it's the same thing with like uranium, for example. I don't need the AI bubble for uranium to go to a couple $100 a pound. It's going there because there simply isn't enough uranium, even for the things that we're building, regardless of how many plants are brought on for AI or SMRs. That's all speculative froth. Fundamentals are so good just because the fundamentals are so good. The supply demand is so skewed with nobody can show you, how this is going to get resolved. And if you add that increased demand, well, then forget about it. So here's the IEA flip-flops on oil demand projections. Peak oil demand isn't so certain anymore. Wow. When did they wake up to that? So under current policies, the IEA doesn't see oil demand peaking even under more aggressive scenarios. It barely drops by the middle of the century. Current policy scenario, I mean, this is understated too, folks. This was, net zero emissions by 2050 scenario that everybody that knew anything knew was stupid and was never going to happen. Here was the stated policy scenario that like oil demand was going to slowly tail off. And then the current policies. Current policies, I would take this up to 130, 140 million. This is going to, again, unless you have major global economic dislocations like pandemic, great financial crisis, things like that. There's only been 4 times in the last 50 years that oil demand has went down, and then it bounces right back. Okay, and it's not just because of fresh recessions in like the U.S. or Europe. It has to be major global economic dislocation, like shutting the entire world economy down. And you saw what happened. Yes, oil prices crashed. Oil demand was only off by about 20 or 30 million barrels a day at its worst, and it came right back. That shows you how important oil is to civilization. And so again, I don't care about the US economy and its effect on oil demand. I care about the emerging markets and India and Africa and Bangladesh and these places where oil demand's only a half a barrel a day or half a barrel a year per capita. If it goes to 3/4 of a barrel or a barrel, this is significant to move this up. So the IA, of course, flip-flops, but they still don't get it. They still don't get it. And this is what OPEC has been squawking about. Now you could say, well, OPEC's in the business of selling oil. Of course, they think the oil demand is going to go up. Yes, OPEC is, or, people that run oil hedge funds or investment funds. Of course, they're bullish on oil. Yes. But what is the core argument? It's showing you oil divided by the S&P is at the same level as in 1998 and 2020. 1998, of course, was the tech bubble. 2020 was the pandemic. So relative to the S&P, uh, S&P energy relative to S&P 500 and WTI crude divided by S&P, you see where we're at. Okay, this was the tech bubble. Okay, and then the subsequent commodity super cycle that we had when China. And then here's the COVID lows. You saw what happened off that, and we're at these lows again. Um, what I call the AI bubble lows. I mean, this is no guarantee that oil prices or oil stocks are going to go higher, but I think that they are over the next 3 to 5 years. I think you're going to do tremendously well in these companies. All right, guys, that's it for this week. Thanks for subscribing. Please come by the Substack, check it out. We have, again, the free weekly AIA email that comes out with all kinds of good stuff in there where I curate podcasts, articles, interviews, what have you, about all of this things, that subjects that we're talking about here. Very interesting. That's free. And then, of course, we have the paid product, the Actionable Intelligence Alert newsletter, the asymmetric portfolio, and the dividend dripping roast portfolio. So those are paid products. Those are consistently beating the S&P. So come by, check that out, and become a member. Thanks for your patronage. Thanks for watching, and we'll talk to you next week.